Good morning. Welcome to Brownfield's Quarterly Market Outlook webinar. I'm anchor reporter Meghan Grebner. With us this morning, we have a fantastic lineup of ag economists, Kenny Burdine with the University of Kentucky, Scott Brown with the University of Missouri, and Joe Outlaw with this A&M. We're going to get into a bunch of different topics today. We're going to talk a little bit and recap some of the big reports that we've had recently. And then we'll open this up to questions to you as well. If you have them, please feel free to submit them through the Q&A button. And again, thank you for joining us, and we look forward to today's conversation. Gentlemen, let's start with a quick recap of some of these reports. Scott, I'm going to kick it off with you, and we'll talk a little quarterly hogs and pigs report. As you take a look at those numbers and that report, what are some things that stick out to you?
So I think number one, Megan, when we look at what we got out of hogs and pigs is that we have inventory that's continuing to be lower than maybe we would have anticipated prior to that report. For me, the big news out of that report was pigs per litter that continued to be below expectations in terms of pre-report estimates. But I also want to remind us that when we think about overall breeding inventory, from 2014 to 2020, we went from about 5.8 million head of breeding inventory to 6.5. So almost every year we were talking about increases. We've now turned over and gone from 6.5 down to about 6.2. That's a very different piece for that industry in terms of no longer talking about additional hogs that need to be slaughtered every year. And I think that's been partly responsible for some of the higher prices. When I look at the remainder of 2021, sows farrowed or expectations of sows farrowed for June through November, to me, continue to suggest tighter hog supplies for most of the remainder of 2021. Also good news. If we look just a little bit at where that inventory is at, breeding inventory in particular, we're going to talk about states like North Carolina, Missouri, Iowa, Ohio that had fewer inventory of sows out of this report relative to a year ago, and places like Illinois, Indiana, Nebraska that actually had some growth in sow inventory. So we've been moving it around just a little bit as we look over the last year. But good news, I guess, from the supply side, tightening up on the hogs and pigs report we got.
Kenny, let's talk cattle on feed numbers. As we take a look at that report, what are some things that we're thinking about? I know we're going to talk a little bit about the drought coming up. I'm sure that's something that I noticed in when we take a look at those numbers, but what are your thoughts?
Yeah, a couple of things I'd point out. I guess, first of all, you have to be careful comparing anything to 2020, and that's kind of the way we tend to look at reports like that. And the on-feed number, the total on-feed number was virtually flat, which I think does tell us something. By June 1, we were starting to move towards something normal to slaughter. The numbers that get the most attention, I think, in this report are really going to be the marketing and placement numbers. That marketing's number was actually up 23% from 2020. But again, put that in perspective. That's, of course, marketing's for May. And, it was like this second week of May in 2020 when we kind of reached our bottom, if you will, in processing last year. So that number is really a reflection more of how low marketings were in 2020 as opposed to what's going on in 2020. So to put that in perspective, I'd like to kind of go back and compare to 2019. And that market number was actually about 10% less than 2019. So although the number looks really big and get a lot of attention, again, it's more a function of 2020. To me, the most bullish number in the report was really the placement, which was 7% below last year, and that was consistent, by the way, with 2019. And I always kind of like to look, okay, how does that compare to what the expectations were pre-report? And that was very much on the lower end of the range that was kind of forecasted by experts. So that was a fairly bullish number, I think. Megan, you mentioned drought that has potential impact on feed numbers. Certainly it does. I'll add one more that I kind of watch, being in a very feeder cattle-oriented state, though we're seeing a lot of movement in feed prices as we speak, obviously. But, you think about where we are now, feed price, wise compared to where we were 6 and 12 months ago. These higher feed prices also have potential to impact on feed numbers, right? The higher feed prices are, that tends to kind of delay placements on feed and encourage weight to be placed outside feed yards. That's a pattern I'm going to be kind of watching in the future as we kind of go forward with cattle on feed numbers.
That leads us into Joe. We're going to talk a little bit about those acreage numbers. As we talk corn, soybeans, input prices, what are some things that maybe stand out to you?
Well, the first thing is that the trade really thought there was going to be a lot more acres relative to the March report. It was up, but you saw what happened in futures that when it was announced, they went kind of crazy. The big deal to me is as someone who looks at, I'm a policy guy that looks at these numbers. I don't live these numbers like these other two guys do. I look at these numbers and I kind of study them. The first thing that sticks out is, corn and beans, add them together, they're almost a record acres. So where did that land come from? Well, it came from the South, basically, cotton and rice, probably some other things that I'm probably forgetting. But with regard to the expectation, someone who's sitting around that doesn't do this every day, I was really surprised we weren't getting more acres of corn. Really surprised. And what is that going to do for down the road? Obviously this year, if producers haven't priced their crops yet, they should probably just quit, at least try to protect this, because the fact of the matter is that, yes, we could have a weather market, but in just the last day or so, the forecast is that we're going to have rain in the Midwest, so some of these dry spots, and we're going to could potentially have a bigger crop. So anyway, when you boil all those things down, it looks really good for this year. And I just kind of tell folks that it looks like you could price into next year as well, pretty right now, and they need to start thinking about it, because once all these other countries don't have droughts and don't have problems around the world, we might see a little bit more normal looking prices.
So that is those are the numbers. Those are kind of the starting off point for us, and we have a lot of other things to dig into. I'm going to start with probably the hottest topic, one of the hottest topics right now in the cattle industry, and it's all about cattle market legislation. And as we take a look at this, what are some things that we need to think about as producers, as an industry, as we potentially walk into a legislative fix to a price imbalance in the cattle industry? Joe, I'm going to start with you.
Okay, so this will be quick. We're working on this report for Congress, and anything I say would probably be perceived as being letting the cat out of the bag, which I cannot do. All I can say is you've got the two experts. Why don't you ask them that question? The reality is that we're working on a report. This is a very complicated issue. It's not as easy as some people want to make it sound. Hey, prices aren't passing through quite as well. It's a lot more complicated than that, and I'll just leave it there.
All right, Kenny. Joe, thank you. We'll lay the heavy lifting on you and Scott when it comes down to this. Let's start with you, Kenny.
I'll provide a few thoughts and be glad to hear certainly what Scott's got to say. But first of all, I would say that, like a lot of people, I would like to see more negotiated trade. Value in that, and I think it's a good way to really value any commodity, particularly cattle in this case. So I fully understand that. As an economist, though, I think we also have to think about what are the implications of the things that we do, right? And specifically with some of this, we're talking about mandating a certain level of negotiated trade, right? And by doing that, we have to be cognizant of the fact that we are taking away some tools that are at the disposal of the folks that are entering these transactions, right? Particularly in this case, packers and feed yards for the most part. So, towards more formula type pricing and other arrangements, right, is because of potential cost advantages, right? And, there's savings in terms of transaction costs, there's savings in terms of marketing costs, there's negotiation costs that are saved. There's even a literature on failure risk and how that impacts negotiations and so forth. So, the bottom line is by doing something like that, one risk that we take is we do impose additional cost downstream. And, as someone from a feeder cattle state, I worry about that trickling back and impacting values of cattle, at the cow calf and backgrounding level. So, that's kind of the big picture concern that I've got. So forgive me for the long answer, Megan, but another piece that I think is interesting to think about is that contract library that's kind of been out there in some legislation. And we don't know what that would look like exactly, but I think we have a pretty good idea by looking at what the hog contract, like the swine contract library. And that really is, it's kind of a catalog of these pricing contracts. And it does add some transparency. You can see what base prices are based on in formula trades. Premiums are shown if they exist, even things like, transactions or weigh conditions, delivery, things like that. So, to me, that's another piece of this that doesn't get a lot of discussion, is the idea that we might have a contract library come out of some of this discussion going forward.
Scott, do we worry about unintended consequences with this is a good idea now, or maybe it helps now, but what does it do long term?
Well, I think anytime you talk about mandating trade levels, we want to proceed with caution. Having legislative fixes to what are perceived as markets not working as well as they should certainly has implications. I'll echo Joe here for a minute. Even though he only gave us 10 seconds of an answer, it's complicated. I think a lot of times we have folks who are very sure they know that there either isn't or is a problem with fed cattle markets right now. And I go, for me, this is a lot harder issue to really get your arms around than those quick responses of it either is or isn't broken. I think it's good that we're having the discussion about how fed cattle pricing's happening today. I, being the economist, often will say I think there are economies of scale to large cattle processing plants. Whether we talk about a situation where we don't like that 4 packers have more than 80% of the market and we want to break them up. What that does to scale economies is something that we have to think about. Relative to the more negotiated trade, I agree with Kenny a lot. More negotiated trade is better for price discovery. All else equal, there's no question about it. However, I don't want us to equate better price discovery with higher prices. I think sometimes that's what's been really at play here, because margins are very wide for packers right now. And so the discussion is, if we have better price discovery, we might get higher prices. That's not the right definition of better price discovery. To go back to your question maybe a little bit better, Megan, you look at the dairy industry, an industry that's got a lot of regulation in terms of how pricing happens. We price cash cheese on a daily basis, don't have but a handful of trades most days. There's a lot of concern about how thin that market is as well, but it's continued to operate at the CME now for a decade and a half or so at least. And so that's one issue. But then you think about all the complication of, I want to take those dairy product prices and get them back to producer milk prices. We can start talking about federal orders, make allowances, et cetera. And I go, I think the dairy industry at times might struggle with all of the complication that comes with more government involvement. So what should those make allowances be? Should they be fixed? Should they vary depending on things like energy costs, labor costs, et cetera? Hard to legislate those kinds of flexibility in that connection. And so let's make sure we do a good job here of talking through the issues, figuring out a best strategy. I sometimes will say it's hard for us as economists to have the perfect answer to whether or not we have good price discovery. It is very hard to measure and have an answer.
I think the other part of that question. I mean, obviously we're talking about prices as well, but we've seen some other pieces of legislation like the Ramp Up Act or to help us expand processing capacity and funding for more processing. How does that play a role in what happens in the cattle industry in the coming years? Because we're obviously not going to get those plants online as quickly as we may need at this moment.
I'll jump in. I'll jump in and say shackle space is an issue right now. It's not the only issue in cattle markets. So I think sometimes when we as economists talk about that we're running big slaughter numbers relative to capacity, some think that we are saying that's the only issue at play here. I'm trying to be cautious to say I'm not sure it's the only issue here, but it's a part of the story. When you look at Saturday slaughter runs for much of 2021, they tell me that we're pretty tight on shackle space. That capacity is a good thing for us. It's probably the first time in a long time that we've been in a situation where we've not had enough capacity in the cattle side. It's been an industry for decades that's been in a downward decline where even though we lost plants over time, we were losing cattle at a fast enough rate that we weren't in a situation where we didn't have enough shackle space. It doesn't fix things here in 2021. I think you're right. Some of the smaller processing that we have helps, but it's still small potatoes relative to the big plants that we have out there. So it's not going to be that helpful. I know we're going to have a drought discussion. I frankly keep saying that drought in the West and in the Dakotas could be what turns cow inventories down enough to actually get packer margins a lot tighter than where we sit today.
Any thoughts from you?
Can't really add a whole lot to what Scott said. He did a great job laying it out, but just, holding everything else constant, when you've got increased capacity, which I think we're looking at, over the next year or two, that certainly bodes well to cattle prices. And, just to kind of quickly say, I think what he was saying with drought, but even outside of drought, if you just look at what cow numbers have been doing in the last few years, right, this increase in capacity over the next year or two, should coincide with what should be, fewer cattle out there on feed, fewer cattle moving through the system. And both of those things, I think, are positives. You think about a longer run expectation of price.
So let's talk taxes. Joe, you recently testified in Congress about a study that you guys have been doing. Can you kind of recap your findings and some of the things that you were discussing there?
Sure. We were asked by the ranking members of both the House and Senate Ag committees to do a study of two pieces of legislation that originated in the Senate. The first one is sensible taxation. I don't know. It's basically, we call it the STEP Act, and it's the one that does away with the stepped up basis. And that's Senator Van Hollen. And then Senator Sanders has something called the 95.5% Act. And that's one that basically goes back to 10 or so years ago, levels of estate tax exemptions, right at $3 million a person or $7 million for two. So we did an analysis using our representative farms, and what we you have to assume that there's a generational transfer. If there's not Scott used to do this kind of work all the time. You do an analysis, but there's no death. There's nothing happens, and this legislation doesn't matter. So assuming a generational transfer, which means that basically it's going to go to the descendants, it's not just going to go to a spouse, it's going to go to the children or family. We assumed that was going to happen across all of our representative farms. We've got 96 of them, I think. They're coming and going. But the long and the short of it is, when you look at this analysis, the elimination of stepped up basis impacted almost every one of them. Why? Because there's a lot of farmland out there that has been in families for quite some time, and the basis has never changed from the initial purchase. And so we had to do a lot of work with our panel members, the folks that represent us, that we work with, about 550 people across the country. We polled them, and they said, we have the different inventories of land, and among the oldest land is about 30% of what we have. And that is the part that would really cost. So when we did the analysis, representative farms, there's 2,000 acre farms up to 10,000 acre farms, but across all of them, the eliminating stepped up basis would be about $750,000 tax hit for them. If you go to the reducing the amount of estate tax exemption, that would only impact about 44% of our farms, but it would be about let's see, I'm going to make the numbers right, 2.1 million per operation. So a little less than half of them would be impacted, but when you're impacted, it's going to cost you. And so then when you combine them together, you impact 98% of our farms, and the combination of them, it's a weighted average deal. It comes out to be about $1.2 million a farm. The big question there is, there's been talk in Washington in the Biden administration about what you'd call exemptions or exceptions that you can provide agriculture. And I don't want to say that our report is damning for this legislation. They may still pass it. But what I can say is it really has shown that they need to do some exemptions and exceptions for agriculture. Otherwise, it could potentially hit a lot of people. And I think that's really the take-home message that people need to be looking at.
When farmers have these conversations, or when farmers look at that, what conversations do they need to have then with their representatives when they see figures like this to make sure that they remain represented and protected as well as they can as they go to pass their farm from generation to generation?
One of the things I think that most average people don't think about is how much assets are on farms, between either land and between the land and the equipment. Producers who are talking to their representatives should say that there is absolutely nothing special about my operation. I'm just a normal person. I have invested over time. The family has invested. We keep pouring our money back into our operations. Unlike corporations that do whatever they want to with them, we keep reinvesting, and so our operations have grown in asset value. And if you start taxing them, and there's been this discussion about, well, if it's directly, if you leave it to direct into your children, then they won't face a tax. But if it ever leaves the family, they're going to face a tax. Well, I'm in the same position right now where I'm going to inherit some land. And if I leave it to my children, that's great. But if they try to sell it, they're going to get taxed. And so all these things have to be taken into consideration. It is a lot. It's like the beef market. It's a lot more complicated. The big thing is, unfortunately, a lot of ag families don't have estate plans, and they need to really think about getting their act together before, in addition to going and talking to their representatives.
Scott, you and I talk about risk management all the time. How much does that estate planning, and while nobody wants to talk about it necessarily, critical to maintaining farming operations from generation to generation?
It's absolutely critical to think about that estate planning. And I agree with Joe. There's so many that don't want to take time or don't want to have to sit down and maybe have hard conversations as you think about where that land goes, where the cow herd goes in front of us. But much better to have that conversation up front than not doing it at all. And I think that's the important piece of this, that too many people are postponing it, not wanting to have hard conversations. Find someone that can help you sit down as a family and go through that process. There may be pain along the way, but the end goal here is certainly important to many of these operations to move forward.
Kenny, do you see when you work with Extension or when you're working with educational programs as well, is that an opportunity to maybe spark some of those tough conversations as we talk about profitability, the ability to move forward and continue our operations as they have been?
Absolutely. I think, there's a lot that I think we can bring to the table, extension professionals, and sometimes it's the kind of things that you ask, Megan. What questions should I be asking, my tax advisor? How should I be engaged with the legislature? And something else that I would add, I think this is kind of where you're going, is one of my thought on that is sometimes the simplest questions are the ones that don't get asked, right? You may have one party that is very focused on, okay, how can I pass this down to the next generation? And the question may have never been asked, do you want to own this farm 20 years from now, right? And sometimes, just simply knowing what the goals are of everybody involved and then taking that to someone who can help you put together a plan, to get you there really needs to be step one. And sometimes I think we just forget that basic step, for both parties to lay out, what do you want to happen with this farm over the next, 10, 20, 30 years?
It's very interesting to have this conversation, and when we talk about risk management and kind of tying it into the broader picture, some of the other things, I'm going to kind of switch gears a little bit, when we talk about legislation, obviously the WOTUS conversation has picked up again, and I think the other one that I look to, that I think about that maybe is a little ahead of the game, is the Farm Bill. And when we look at that, Joe, I'm going to start with you. When we potentially look at the upcoming Farm Bill, do we anticipate some change in crops policies, or what kind of crops policies conversations do you anticipate over the next few months, years, so on?
Right. Honestly, having done this a long time, this is one of the few times where I'm going to say that I'll be shocked if there's big changes to the crop policies. Why? Because there's probably not going to be a big infusion of cash to do anything different. Where I think the biggest changes are going to be is I believe, and this may be a later topic, but the climate change stuff, the smart practices, I believe is going to be a Farm Bill issue, and I have been a little surprised that the administration kind of came out of the gate talking about it, what all was going to happen, and then we've kind of had silence for a while. And so I think it's probably, they figured out it's hard, and it's going to be hard, and they're going to probably leave it to Congress to try to figure out where they want to put some more conservation type money. And so that's my 2 cents. Not much change to commodity policy. There's just not money for that unless somebody gives it to them. And I think most of the excitement this time is going to be on the conservation side.
How does that impact the cattle side, Kenny?
Historically, beef cattle producers have been mostly impacted by emergency stuff, indemnity programs, things like that within the Farm Bill. And like Joe said, there's probably not going to be a lot of money for new types of programs. You didn't really specify beef or dairy cattle. I'll mention dairy briefly as well, if you don't mind, Megan. The dairy policies has been one that has evolved, quite a bit over time. And I get my farm bills mixed up, so forgive me, Joe, but I won't be able to roll off the years here. But a farm bill ago, there was the MPP, the Margin Protection Program for dairy, and then that was modified towards the end of that farm bill, and then we now have the Dairy Margin Coverage Program, which, from my perspective, has been received a lot better by the industry. So, I kind of agree on the thing you said on the crop side, that we'll see maybe evolution, not revolution, with that particular program. One item, though, that I think could come up again, that's already been discussed quite a bit, is the change that was made in the last farm bill to how the Class 1 dairy mover calculated. And there's been some discussion about that. Historically, it was the higher of the Class 3 or Class 4 that was kind of used to set the base. And last farm bill, we went to averaging those two and then adding 74 cents. And that was really supposed to be kind of neutral in terms of the impact. But over the last 18 months or so, we've seen a lot of divergence between Class 3 and Class 4 milk prices. So it's led to some pretty wide producer price differentials. So I think that may be something else on the cattle side, the livestock side, that might show up as something in this next farm bill as well.
Got any thoughts?
I think both Joe and Kenny have covered things well. I will say, it's interesting if we take crops policy for a minute. So we've made MFP payments, we've made CFAP payments, we've rolled a lot of dollars out the door unassociated with the farm bill. I think Joe correctly has pointed out that it's hard to get new monies in the farm bill to do anything new, but I sure see us having the discussion about, do we have an adequate safety net when we've come back a lot recently with these other forms of payments. Now, I might argue both China and putting tariffs on our soybeans in particular and COVID-19 were events that are very hard to put a safety net together for in advance to cover. The last piece I'll say is I'm interested to watch whether there's any interest in a livestock competition title in the next farm bill. I think the answer is probably no, because as we all talked about, it's hard to find common ground in that, but I could see some discussion about a new title that we haven't seen in the past, but I'm only guessing, I guess, at this point that there will be that opportunity.
Let's talk briefly about the broader economy and the continued recovery. And I don't want to spend too much time on this because I really want to get into this drought conversation and the weather conversation. But let's talk a little bit. How much are we watching the continued COVID recovery, the broader economy, jobs reports, as it relates to demand for both beef and pork, and ultimately the consumer side of that picture? Kenny, I'm going to start with you.
Provide a little perspective here and hear what everybody's got to say, of course, but certainly watching it very closely. COVID, the way I guess that I describe what COVID did, it kind of hit in phases, but it really impacted beef demand as much a function of how and where beef and other meats were consumed as much as. So, we're actually, from my perspective, we're seeing some pretty strong demand across the board. And, something that I always like to watch, especially now, is that restaurant performance index. Just an indicator, right, of how restaurants are doing. But, no surprise, they're seeing a lot of recovery. Now, I don't like to use a lot of anecdotal stuff when I do things like this, but sometimes you do, right? But I've had the opportunity to travel a fair amount the last month or so. One trip for family vacation, one for a conference. I've been in several different states in the Southeast, and you mentioned labor, and a lot of these restaurants have got signs up that will say something about help wanted. I was even in one back in early June that had a sign that said we are understaffed, please be patient. And you see those sorts of things that I think are impacting that somewhat. The other thing I guess I'm noticing, again anecdotal, is that some of our restaurants that have historically been a combination of think fast food, drive-through, and sit down. I've got several around me that have not gone back to sit down yet. And I think that may be a function of labor as well. And then just very, very quickly to kind of wrap things up here on my thoughts on it. Exports haven't gotten a lot of attention, I don't think, because of so much going on domestically. But if you look at both beef and pork, export pace has been pretty swift, especially on the beef side. And I think that's another positive factor in terms of beef demand going forward. And the same thing for pork on a similar scale.
Joe?
Yeah, the stuff that I look at really is what are happening with input prices, and they've followed prices right on up just like they normally do. The thing that a lot of people, I've gotten the nickname of Dr. Doom a lot because I always look at where things going to break at, and you start hearing about the one thing that we can do if we have inflation is increase interest rates, and those are going to hit our producers with all these high input costs. It's going to hit them fast and furious. And so, it hadn't been that long ago that we weren't, oh no, there's no increases in interest rates on the horizon. And now you hear the Fed governors start talking about possibly sooner rather than later. Still next year, But those are the types of things that I think are really going to change the profitability, especially since input prices are sticky and they're not going to go down near as fast as commodity prices.
That will finish up this conversation with you.
Yeah, so I think number one, Kenny framed very well that demand domestically has been strong for beef and pork. A couple of things. So as I try to look forward here for a minute, I always like to remind us that just because it's been really strong doesn't mean it's always going to be really strong. It also doesn't mean it won't be really strong either, right? But let's make sure we look for a second. And if you look at foot traffic data that's available, and again, that data is anecdotal, as Kenny said, so I don't want to draw too many conclusions, but we started 2021 roughly down 40% from where we were in foot traffic back in 2019, so pre-COVID-19. By the time we got to the end of March, we were back to 2019 levels of set down restaurant foot traffic. So a big growth. And to me, that was the slug of demand needed to fill food service. And so I'm not surprised we've seen really strong demand. Now, the issue for me since then has been that sit down restaurant foot traffic's been flat back where it was at 2019. I don't want to say that's bad, but maybe we filled that food service pipeline at this point. You know, you and I joke all the time about bacon, for example. I still think it's good, right? As I know you do, Megan. But I think perhaps, you know, we're to a point where we won't continue to see the kind of really strong demand that I think we started 2021 with. And then I add on top of that, I think sometimes we get ourselves convinced we're done with COVID-19. And maybe, all right, so we, number one, see some rise in cases in some parts of the country right now. Again, I don't know what that effect really is long term, but I do wonder about income growth longer term. This year's really strong in terms of what we've been seeing in terms of consumption outlays, as we've seen an influx of dollars from the federal government to help offset COVID-19, as we've seen pretty strong wage growth in front of us. I think we saw some savings over 2019 and 2020 that's maybe we're starting to spend against as well. But if consumers look up one day and don't have that same flexibility, what do they cut? And to Joe's point, higher gasoline prices, so some of the other things that they face could also cut away from food expenditures. So I just want to make sure we understand that we might slow a little bit on the domestic demand front as we look ahead, and we certainly want to take advantage of this good time, but that things could look different 6, 9, 12 months down the road.
All right, let's get into this drought conversation, and I think it's kind of two separate conversations: corn, soybeans, hay and pastures. Hay and pasture. Let's start first with the corn soybean side of things. Kind of a different story. I know my folks were just here from Central Illinois, and they've missed the really heavy rains. They've had nice showers, so things look great there, but kind of a different story as you get into different parts of their track from Central Illinois to Central Kentucky. How is it looking in other parts of corn and soybean areas, and how does that play a role in what we think about for profitability toward the end of the year and into the start of the year? Joe, do you want to start there, or do you want us to go to Kenny or Scott?
Well, normally in Texas, we're the champions of droughts, but shockingly, I think ours is almost over. Other than the hay, there's going to be a hay shortage out western part of the state. But in terms of corn and beans, I'll just leave it to those guys to comment on it.
Scott, I'm going to start with you.
So it's funny we're having this conversation right before USDA releases the July WASDE and changes things up on us. But number one, when you see, I'll take corn, and I think we could have the same discussion in soybeans by and large. Futures prices for new crop corn have shaved $1 off over the last 60 days or so. It tells you most folks, I believe, are thinking there's a good chance of a reasonable crop in the bin this fall on the corn side. My own windshield tells me there's a lot of variability as I look at corn in particular, from this tall to over your head high corn in some parts of the state of Missouri. But there is moisture setting there. And I think not a lot of drought. So where Joe would have said, and I think his comment was to crop producers, you had a chance to lock in some reasonable prices. If I'm a livestock producer, I may say there's more probability of some downside movement going forward if we continue to see some rains. So maybe less risk management. Now, God did not say, all right, so if the spigot turns off today and we stay dry for the remainder of the growing season, tough on corn, maybe tougher on soybeans where they sit right now. And so there is upside risk here from an input side, but I think generally I might sit on the sidelines a little bit more in terms of those feed costs, just given that the drought we're talking about really isn't affecting most parts of the country from a corn and soybean perspective.
Hay and pastures, however, are a different story. Kenny, as you look, obviously in Kentucky, we're in a little bit, you and I are in a little bit different of a situation than as we go further west. How does that big picture impact the rest of the year for cattle producers?
Sure. So very much like you said, Megan, where I live, we've been blessed. We've had adequate good first cutting of hay. You typically have either quality or quantity on the hay side, and we have quantity this year, but had some good windows there to get hay up. So locally, trying to just kind of say that off the bat, a lot of areas are in decent shape. Now, as I move further west, there is some drier areas, even me. Then we think about, the bigger areas, the far western part of the U.S. and then the northern plains, which have a lot of cattle. Those are the ones I think that are going to be the most impact and have the most implications on the market going forward. Hay markets tend to be very regional. That's because hay is so expensive to transport. So when we think about those areas and the hay impacts, you're going to see it very regional. It's very likely that we may not see much difference in hay price in this area because of drought out west, right? But we may well see market implications if we start to see some of those calves weaned earlier, if we start to see culling of cows. That's where we could potentially see some market movement on the cattle side if this persists much longer. Thanks.
Scott, you and I have talked a lot about what's been going on in the Dakotas areas and that impact. So that kind of is going to lead us into our final topic, which is a little bit about cattle liquidation. And the conversation is very different in the West than what I would assume it's going to be in Kenny and I's part of the country. How do we look at the greater impact of the drought and the Dakotas areas and what this means for the cattle industry?
Yes, I think when you look at the Dakotas in particular, the thing that jumps out to me is how early this drought has taken a hold of the Dakotas. Really not a chance for much hay or pasture growth to occur. It's so early. Normally when we would have this discussion, Megan, we would be having it in July and August where we were needing precipitation for continued pasture growth and second and third cuttings of hay potentially out there. But now we've got some places there in the Dakotas that never really had a chance to see any kind of spring growth. I think even if you get decent rains going forward in some of those areas, you're not talking about recovery until we get into next year at this point. Yes, we're going to move some cows around. Let's not forget we go back to the 2012 drought, of which Joe's Texas was a big part of that. I think there were some cows that did move around to other parts of the country that came home to Texas over time as they recovered. I see similar things can happen. That the net of that, though, is not zero. We're going to have some folks that are going to choose to liquidate, and it'll take them a while to decide, if ever, to come back in. It's interesting as we talk about potential regulatory changes. Much of this drought is focused on public land. And I think we're already seeing some signs that folks are not going to be able to run cattle on some of that land. And so when does that change? Does that set a long-term path of less grazing of BLM land, let's say, than occurred in the past? Just some really interesting questions. Now, I sit here in Missouri and go, quietly, it's really good for my Missouri producers. They tend not to be in a dry weather situation. So does that move where the cow herd is located longer term? I think the 2012 drought, Joe would say, Texas never recovered from that completely, and it did move some cows around relative to where they had historically been. I just see some similar things that could happen this time with more of a push to the east. The Dakotas, for me, is a little harder to know how quickly they rebuild. I think it could be a little faster there, again, depending on precipitation from this point forward.
Penny, what are your thoughts about liquidation? I'm assuming not really a conversation in our part of the country right now.
Not locally. Our beef cow numbers were down coming into this year. And I think it's important to note, first of all, that really was not weather driven, right? There's drought can certainly drive cow numbers, but so can profitability. And I guess the one caveat I would throw out there is that, we compare this year's cattle market to last year's, and I think about cow-calf level, feeder cattle level, kind of first of all. Sure, things do look better in 2021 than and by the way, fall is the biggest time that matters because that's when most of our spring calving herds are moving their weaned calves. But the other thing we have to think about is, you think about those prices in 2020, and then think about those CPAC payments. They made a difference, right? They offset some of that market loss. So, probably we're not going to have that in 2021. So I'm not sure the profitability picture changes that much when I really account for those payments that have been alluded to already in 2020. So while droughts, and I think we're, as of right now, early July, caveat, right? We're in decent shape moisture-wise in my neck of the woods. I do think that it's going to be interesting just how producers respond to this fall market. Have a fall market that's, a nickel or a dime above where we were in 2020. That's still not what I would call a profitable cattle market. And that can lead to liquidation in the same way that drought can in some parts of the country.
Gentlemen, thank you so much for your time again. I appreciate your participation, your comments, and your thoughts. It's been a great discussion. As we wrap up, let's just some final thoughts and reminders as we look forward. Scott, we'll start with you.
Well, so I think number one, expect a lot of volatility going forward. Megan, you and I talk about this all the time, doing some type of risk management. So I'll take hogs for a minute. We haven't had that much discussion there. Hog prices have come down a lot from where we set 60 days ago, yet still some profitable returns sitting there, even where corn prices have been. I hope folks will take advantage of the opportunity to lock in some reasonable returns. Sometimes I will say a lot more singles than home runs, perhaps taking that strategy. But for those that aren't locking in, I sometimes say, well, maybe they should go with Joe Outlaw and play blackjack at the casino, because that's really maybe what it looks like. So there are opportunities to reduce risk. I guess that's the biggest piece of information I want to leave with folks today. And so let's make sure we take advantage of that. I look ahead and can be pretty positive. Let's not let the short run be the problem for us. And frankly, I look at cattle, and there's a lot of reasons, and weather being the main one, of we could get into late 2022, early 2023, and we could have some much, much higher prices. So Kenny's right. Profitability has been tough here of late, but I don't want producers to lose sight of what things might look like a couple of years down the road, due in large part to this drought that we're having. So have a little bit of forward-looking thought as you plan for your operation in terms of changes, whether it's getting bigger or getting smaller or staying the same. Well, let's look ahead for a little bit.
Joe, final thoughts?
Yeah, I guess on the crop side, there's most commodities I'd say rather other than rice are in a really favorable situation relative to prices we've had over the last 7 years, which have been kind of down. I would say that I've had a lot of people talk about using this opportunity to update their equipment, and that's fine if they need it. But to me, I think that they probably need to do some financial management and think about not getting in a lot of debt because we don't know what next year is going to bring, especially if they haven't taken the opportunity to lock in any of these prices.
And Kenny, final thoughts?
Yeah, just a few quick thoughts. There's been, from a livestock perspective, there's just been so many things thrown at these markets the last couple of years. And, it's almost amazing to think about the turbulence that we've seen in all these markets, which has led to volatility. Lots of things. And sometimes there's some comfort, I think, in just stepping back and saying, okay, what can I control? I'm going to focus on those things I can control. And, in most any market, you're better off by responding to market signals and selling the kind of cattle or the kind of hogs, selling what the market really wants. And in a higher feed market like we're in now, granted that's changing some, but we're still in a high feed market. That probably does mean that it makes sense to move heavier cattle off the farm this year than it did 2 or 3 years ago. So think about the things I can do to add value there on the farm at home. To kind of build on something that Scott said, and he made a really good point. And people like me are part of the problem, by the way. We talk about cow-calf profitability kind of in a snapshot in a single year. Remember that cows are a multi-year investment, 6, 8, 10, 12-year investment. So, don't make rash decisions based on a year or two, with an investment that's going to last you for many years in the future, right? The profitability of cattle over time is determined over their lifetime, not over just a second. So think long term. And then last thing I would say, something else Scott mentioned is, focus on risk management. And he didn't specifically say this, but being in a feeder cattle area where I work with a lot of small producers, if you're not familiar with livestock risk protection insurance, LRP insurance, give it a look. It's been around for a long time, but it's a lot more attractive now due to some changes and some increase in subsidy level than it was a few years ago. So, there are some tools out there to help you manage price risk. And I tell folks that price risk needs to be something you manage on your operation just like anything else. We're used to managing our cow herds, we're used to managing soil fertility, we're used to managing labor. Price risk needs to be one of those things that we put in our box. This is something else I've got to manage going forward.
Gentlemen, thank you again so much for your time and your participation today. It's been fantastic, and we appreciate it greatly.
Thank you.
Thanks, Megan.
Just to plug, because Scott and I have a conversation every Friday. If you'd like to check it out, it's streamed live on Facebook. We also send out a weekly livestock market update newsletter. You can subscribe to that at brownfieldagnews.com. And there's also a lot of great news, market, weather content there as well, and a whole host of podcasts. You can go to brownfieldagnews.com/podcast. Have a great day. I'm Meghan Grebner for Brownfield.